Hey, it's John King, and it is March of 2022, the end of March 2022, and interest rates have absolutely shot up. And I've been asked this question a lot, especially over the last month. Have I missed the opportunity to refinance? Well, the answer is maybe, but maybe not. So I'm going to take a couple minutes right now and share with you some details on why it still might be a good idea to refinance. The first thing is, why are you refinancing? There are three reasons to refinance, and it has nothing to do with interest rate. The reasons why you would want to ever refinance, whether rates are high or low, is to pay off your loan faster. So shorten the term on your loan. The second reason you want to refinance is to lower your monthly payment. So decrease how much you're paying each month. And the third reason that you would want to refinance is to pull cash out of your property. Now, if you're looking to shorten your term and you already have a good interest rate, you're best off just paying extra on your mortgage. You're not going to want to refinance because there's fees associated with refinancing, and it's likely to raise your interest rates in most situations because rates are quite a bit higher now than where they were just a few months ago, let alone a couple of years ago. Rates are definitely in the high fours, and they're probably going to be hitting the 5% range here soon. So it is absolutely much higher than the 2.5% to 3% rates that we had seen in most of 2020 and 2021. So that gets rid of the first reason of lowering your monthly payment. If you're shortening your term. If you want to shorten your term, just pay extra. If you're looking to lower your monthly payment, you got to look at your overall monthly payments. I'm going to share that with you in just a second on looking at your overall monthly payment, how much are you paying, and how can you better allocate that payment. And then the last reason we want to refinance is to pull cash out of your property. Now is actually a great time to pull cash out of your property because equity is super high. Values are up. I don't expect values to drop anytime for the next 3 years or so because of something called household formations. And I'll put a link to a video up here right now. If you want to watch it, come back here later and click the button, but don't click it now because I want you to watch the rest of this, but it'll talk about household formations. But that's household formations, by the way, is why I don't think values are going to drop. But we are going to see interest rates continue to go up. I've got another video that I just recently recorded on why did interest rates go up so much. I'll have a link to that one. As a matter of fact, I'll put all the links down below in the comments. So you'll see the link to why interest rates just went up so recently and why I don't think that home values are going to drop anytime soon. But the two things I want to talk about is lowering your monthly payments and pulling cash out of your property. So let me show you this chart. First chart right here. Okay, so when you look at your monthly payment, if this was you and you simply had a mortgage at $300,000 with a 3.25% interest rate, I'm not going to be able to lower that monthly payment. But if you have a home equity line of credit or loan right now, home equity loans and lines of credit rates are going to be significantly higher given the fact that the Fed has raised their interest rate, and the Fed interest rate drives the rates on home equity loans and lines of credit. It does not drive the rate on mortgages, but it drives the rate on home equity loans and lines of credit. For that reason, you're going to see higher interest rates going forward for home equity loans and lines of credit. And so if you have one currently, or if you need cash out, you could get a home equity loan or line of credit, but you're going to be at a much higher interest rate. Now, a lot of people say, hey, John, I owe $50,000 on my mortgage, on my first, I'm sorry, I owe $300,000 on my first, and I just need $50,000 out. So aren't I better off keeping my 3.25% first and just getting a higher rate on the second? And the answer is possibly yes. Possibly you are better off just getting that second. But one of the things that you're missing is the opportunity to refinance later. And let me explain to you what I mean by this. Interest rates go up and they go down. So I'm gonna get rid of my video here so you can see this better. So what you're seeing here is going back to 1975, rates were 7.5, they moved up and we had huge inflation like we're dealing with now. Rates went from 7.5 up to 9, and then they skyrocketed and they hit 17, 18%. But that was for a short period of time. So we're talking about a year that rates were up that high, and then they started dropping again. And this gray line is recession. So there's gray area, recession hit, and with recessions come lower rates. I believe the Fed has not done a good job of controlling inflation. And they're just like what happened in the early 80s, and inflation caused interest rates to shoot up, but we had back-to-back recessions in the 80s because as the Fed raises interest rates, it slows down the economy. Slowing of an economy is the definition of a recession. And with the recession, once the economy slows down, interest rates come back down. That you see that played out over and over again. Rates go up, we hit a recession, rates come back down. Rates go up. In this case, rates came down before the recession, but they came down even further after the recession. And again, we see every time there's a recession, interest rates go down. So if you need to pull cash out of your property right now, you can pull cash out and be able to refinance again in a few years. I'm not sure if it's going to be 1 year or 3 years from now that we're likely to see a recession, but we are likely, can't guarantee it, we're likely to see a recession in the next 1 to 3 years. That's going to allow you to refinance. And at that time, it won't be a cash out refinance anymore. You pay, this is Fannie Mae who decides for all lenders what the risk is on a loan. And Fannie Mae says, hey, no matter what your circumstances are, you're going to pay a particular increase to the cost of your loan based on this chart. This is for everybody based on your credit score and the percentage I'm loaning you on your home. This is for when we're just refinancing what you owe or you're purchasing a home. But when I scroll down here, cash out refinance, there's a whole extra layer of fee that's added that everybody pays. No matter if you have the best credit score with the best equity, you're still paying a higher interest rate when you're pulling cash out of your home. So why not pay that higher rate now for a short period of time? If you got an interest rate today, even if it was in the fives, if we go back to this original scenario, you look at all of the debt that and this is not an uncommon scenario. I don't know if this is you or somebody you know, but the truth is, if this fits you, this person has almost $40,000 in credit card debt with interest rates that are ranging from 21 to 28%. And that's pretty low rates compared to where they're going to go with inflation and the Fed raising the prime rate. It is going to cause an increase in in your interest rate for your credit cards. So this person is actually, even though they have a 3.25% mortgage, their blended rate is 5.5%. So if you could get a monthly payment or an interest rate of less than 5.5%, you are saving money. Let me open up my picture again here. So if you can get an interest rate of less than 5.5%, you are better off. Plus, this all becomes tax deductible. You are currently getting no write-off here, and you're gonna be able to get a write-off on all of that money. So what I'm telling you is, if you are thinking about pulling cash out to consolidate debt, or if you're thinking about pulling cash out for home improvements, equity is up. You're in a position to cash out up to 80% of the value of the home. I don't want you to treat your home like an ATM machine, but I don't want you to miss this opportunity by thinking, oh, rates are up, this isn't a good idea, I don't want to have that high rate for a long time. If we look back at the history of where interest rates have gone, as I explained here, you're looking at temporary increases, and within a couple of years, they come back down. So I expect we're going to see the same thing. Nothing is permanently up, and you're going to be able to refinance then, just refinancing for what you owe instead of pulling cash out. You don't have to pay this additional increase onto your loan cost simply because you're not pulling cash out the next loan that you do. That also plays into the question of whether you pay a lot of fees or a lot of points on the current loan. There are scenarios where we're going to talk about it to say maybe we're better off paying less in fee and taking an even higher interest rate, because the goal right now is for it to be a shorter term loan. Now, sometimes that's not an option depending upon your credit score and where the rate market is at that day. We might have to pay more in fees, but we want to compare and contrast to say, is it worth paying the fees when it's likely that we're going to refinance in the next few years? If that's the only way we can get the loan done, then it is better off than paying what you're paying today and keeping that higher interest rate, especially the higher blended rate, without the tax deductibility that you get by putting it all together into mortgage. I hope this all makes sense, and really my goal here is to help you understand what your options are and help you understand that it is not too late to refinance. It just takes the right advisor giving you the right advice, and I would love to be that advisor for you. Let me know if there's anything I can help you with, and have an amazing day.